Hi, good evening, everyone. Uh, I was kind of dreading the fact that I may have to speak just before tea. And when I saw the schedule, I was very thankful that I'm speaking after tea. So, all of you are refreshed a little bit. Thankfully, and hopefully you'll be able to participate because I have a couple of questions that I'll be asking you through the session. So first of all, I'd like to start off with thanking Prem for giving me the opportunity to be here. Prem is known to everyone. He's built Cafe Mutual from scratch, which is focused on distributors and your interest. And he's established this event as one of the premier IFA events in the country, so that takes a lot of doing. I'm also humbled by the opportunity to speak to, to all of you, to have the opportunity to address all of you. All of you have not only built up your own individual businesses from scratch, but you've also helped in a meaningful way to build up this industry. The mutual fund industry would not have been what it is without your contribution, and you guys have led that. So, I'm truly, truly humbled to be here speaking to you. The topic that has been, that I'm going to speak about is about the alpha that has been generated by equity mutual funds over the last few years. Indian mutual funds have done very well, developed markets not so well. And what is the future? Can we manage to generate this kind of alpha going forward as well? And how does it pan out? Is it normal that as markets progress in the development stage, that the alpha generation comes down? That is what experience seems to tell us. But I have a slightly different take on it. And this is the point at which I'd like some kind of interaction. I have two questions to ask, and if you can just, by a show of hands, how many of you think that it is absolutely necessary that a fund manager, that a fund should not underperform the index? Should not underperform the index. Okay, absolutely necessary that the fund should not underperform the index. Okay, how many of you think that it is absolutely necessary for a fund to outperform the index? The two are not different. The two are very different. Let me explain. But first, I'd like to see a. Okay, so a fraction of the people think that a fund should outperform the index, but no one really likes underperformance. So what we're talking about is negative alpha, positive alpha. Negative alpha is not tolerable. Positive alpha is desirable, but I mean, we are okay if it is more or less in line with the index. So that is exactly where the global experience is as well. Now let's step back a little bit and look at what happens in our country. When we compare fund performance to an index, are we comparing apple to apple? In technical terms, we are comparing a portfolio to a price return index. It is not the total return index. It does not take into account the dividends that have been declared by the component companies in that. That is about 1 to 1.5%, depending on what market conditions are. Given how the markets have been behaving over the last couple of weeks, should be closer to 1.5% now. But it's about 1 to 1.5%. So then, and the portfolios are getting the dividend from their component companies. So it is natural that a fund should outperform the index by 1 to 1.5%. If you adjust for expenses, probably the 1.5% is used for expenses. Fair enough. Okay. On one hand, you have an index which reflects only the price movement of the stock. On the other hand, you have the portfolio which reflects the price movement and the dividends. So there is inbuilt alpha in every portfolio when you compare it to a normal index and not the total return index. The total return index is also available on all the respective websites, but that is not the one that is tracked. No one talks about Nifty TRI. No one talks about Sensex TRI, the total return index. What we focus on is the normal index for us, which is the price return index. It does not take into account dividends. Invariably, if you look at, no matter what kind of time period you look at, invariably, you will find that a third of the stocks in the index are outperforming the index. 1/3 are performing more or less in line with the index, and 1/3 are underperforming the index. This holds true in bull markets, bear markets, sideways market, holds true all the time. Just adjust the band, it will always hold true. So I find it difficult to believe that a fund manager who is consciously choosing stocks which he believes are the future of the country would find it difficult to outperform an index which is mathematically created, which just takes into account, mathematical parameters like market capitalization or some such stuff. Indian indices are mostly capitalization based. So I find it difficult to believe that a fund manager can't do that. Current market conditions, last year, we've seen a lot of the funds have not only outperformed the index, but they have also corrected the underperformance that was there for a couple of years, because the scale of outperformance has been huge. It's been absolutely massive, right? Where did this come from? Did it come from the right choice of stocks, the choice of what to buy, or the choice of what not to buy? It was clear to people a year ago that commodity stocks are not going to work very well. Most of the outperformance that has been generated over the last 1 year has been outperformance of exclusion. People did not buy the commodity stocks, and hence they outperformed. Now that is possible under all market situations. So I find it very, very difficult to believe that a fund manager can sustainably underperform the index. Okay, an index which is constructed purely on the basis of mathematical parameters and has absolutely no qualitative analysis going into it. So to my mind, all fund managers over longer time period should outperform the index. But then the evidence tells us otherwise. When you look at the developed markets, the evidence tells us otherwise. There are, a large cross-section of the funds out there which are underperforming the index, and the same holds true out there also. 1/3 of the funds will underperform, 1/3 of the funds will perform in line, 1/3 of the funds will outperform. So if you don't buy the ones that are underperforming, you should be able to outperform the index. So why does this happen? So here, I'd like to mention a research study that has been conducted by two academics, Del Guercio and Reuter, in 2011, covered the US markets. It's published by NBER, and if anyone of you want a link to it, if you can just give your contact details to my team out here, I'll make sure that you get a link to it. In the summary, in the final analysis, the summary says, importantly, within this direct sold segment, so they analyze funds in two parts. Okay, who sells the fund, whether it is being sold directly to the investor or through distributors. Okay, it says, importantly, within this direct sold segment, we find no evidence that actively managed funds underperform index funds. In contrast, we show that actively managed funds sold through brokers face a weaker incentive to generate alpha and significantly underperform index funds. This is a study that covers the US market. So we said, is it true? I mean, I was very intrigued by the study. I wanted to understand, how does this work? Is it really true? I mean, the fact is, when you look at the analysis that is conducted, what it focuses on is whether distributors sold funds, which means distributors like all of us, all of you out here, actually reward funds that are outperforming and punish funds that are not. Does it reflect in the assets that they manage, or does it not? So we did a very, very simple analysis of the Indian market today. Funds performing as of today, I took just one of it. One segment, which is the multi-cap segment, okay, has about 90 funds, 80, 90 funds, which have been around for 5 years, which have been around for more than a year from Value Research. And ranked it by AUM, the largest being at the top, the smallest being at the bottom. So ranking it by AUM, what you can realize is a very simple phenomenon. The top half, which is the largest funds, okay, and you're just looking at the half together, have an average rank, and we've ranked it, so obviously you know that the middle rank in the last 1 year, I mean, funds which cover a 1 year period are 79, 3 year period 74, last 5 year period 68 funds are there in this universe. In the top half, the average rank is about 29.68, which is above the average. For a 3 year period, 74 funds, the average rank should be 37, but it's 29.68, which is above the average. And for the bottom half, it's 45.04, which is well below the average. So all of you are actually making a choice to give more money to funds that are outperforming and less money to funds that are underperforming. You're making that choice very well, and that is very obvious. But within the top half, there is no significant difference between the top 25% and the second 25%, and the same holds true for the bottom half. There is no difference between the third quartile and the fourth quartile. There is not much of a difference in average rank, which ties in with what all of you said. Underperforming funds, we don't like at all. Outperforming funds, okay, we don't really care whether they outperform by a huge margin or by a small margin. Now, this is something that will drive fund manager behavior. What is the reward for a fund manager who tries to outperform the index, who tries to generate significant alpha? The reward is in getting more AUM to manage. Is that clear? I mean, that is the only reward that a fund manager can have, right? The more AUM to manage. So there is significant evidence that you choose outperforming schemes and shun underperforming schemes. But within this universe of outperforming schemes and underperforming schemes, there is no significant evidence that you favor schemes that generate more alpha over those who generate less. And in the bottom half also, there is no significant difference between people who generate a little less, who underperform by a small margin, or people who underperform by a wide margin. Now, once we understand the link between management and reward, between alpha and reward, it is completely your actions which will drive whether a fund manager is encouraged to create alpha or not. The ability exists, but creating alpha is a lot of effort. And for that effort, for the teams that need to be put in place, are you rewarding them with higher AUM? So as always, this industry will be driven by your choices. It won't be driven by what the fund manager wants, because the fund manager will do exactly what you want him to do. If you reward funds that generate significantly high alpha with more AUM, there is a natural encouragement for the fund manager to significantly outperform. If you don't make that difference, fund manager is very happy generating 20, 25, maybe 50 basis points alpha over a period of a year. And if you're okay with that, okay, that is where it's not a one-sided tree. It's not just the fund manager. The ability to generate alpha exists. That I said in the earlier part, where I said the ability to generate alpha always exists. Where is the incentive? The incentive is in your hands. So if you want this industry to be one that keeps on generating significant alpha, that keeps on outperforming the index on a continuous basis and tries to outperform the index by a reasonably large margin, then it is up to you to reward those funds. And if you reward them, then that becomes part of our culture, and you will see alpha generation continuing. On the flip side, if we follow the US model, where they just don't care, where the distributors don't seem to care, okay, the incentive to generate alpha just disappears. And no one will generate alpha. So that's all that I have. I'm open for a couple of questions if I think there is time, a minute. Yeah. So we have a little bit of time for a question if there is any. Okay, I guess that's it then. Thank you very much, and thank you once again for the opportunity.